Hey everyone, welcome to the session about the challenge that tariffs impose for central banks. And I'm sure there's a lot of that out there right now. I'm your host, Joeri Schasfoort, and today I'm joined by the one and only Charles Goodhart, Emeritus Professor at the London School of Economics, as well as Doug Laxton from the Better Policy Project and Vasgen Poghosyan from the Central Bank of Armenia. Trump has last week announced his reciprocal tariffs, shocking everyone because it was based on bilateral trade deficits divided by two, and then yesterday paused most of them, leaving a blanket 10% tariff in place, along with huge tariffs on China, as well as some sector-specific tariffs still like car industry. Today, we're discussing these policies in light of the Forecasting and Policy Analysis System, Mark II, FPAS Mark II, which distinguishes itself from other frameworks for a large part because it uses scenarios. Professor Goodhart, let me start with you. How do you think that Trump's policies might be measured or modeled or handled in an FPAS Mark II framework?
Well, let me try and set out the situation. As you've indicated, his plans are grandiose, extremely uncertain what he hopes to end up with, and economically extremely misguided. All this has meant an extraordinary increase in uncertainty and risk everywhere. Nobody knows what is going to happen. Nobody can really forecast. Under these circumstances of extreme risk and asset volatility, as you've seen, the result is going to be that everyone is going to reduce their investment because you don't know what the situation is going to be in future. You can't tell. Meanwhile, the tariffs will raise inflation in the USA insofar as they're imposed, and they will lower exports everywhere, including in the USA. At the same time, fiscal policy in the US is currently based on a misapprehension that the tariffs being introduced will bring in loads of revenue. They won't, because imports will fall, as will American imports as well, and they'll end up with much the same kind of current account. Under these circumstances, they will cut taxation in the expectation of massive revenue from their tariffs. And this will mean that there will be a great increase in the deficit and in the debt. And this is going to make people question the sustainability of the American bond yields, the treasury bonds. Under these circumstances, Trump will be putting huge political pressure on the Fed, on the FOMC, to cut interest rates. This is already happening and will happen more. And the result is going to be a massive upwards shift in the yield curve. The yield curve will become much steeper over time. The effect on the US is going to be one of a huge supply shock with output going down and inflation going up. The effect on other countries is for output to go down quite considerably because of the general reduction in exports. Uh, the the effect on inflation is less clear, but almost certainly, at any rate, in my view, that there will be a reduction in inflation, not only because output will be lower, but because import prices will tend to be lower. We have already seen one of the largest declines in energy prices, in oil prices, which have gone down by about 20%. I haven't looked to see what's happened today. And the renminbi has been cut, and the Chinese will try and shift their exports of goods away from America to other countries and will cut prices with a lower renminbi in the process. It's very difficult to tell what the effect of going to be on the exchange rate of other countries or indeed of the United States. There are some forces that will push up US exchange rates. are going to be some forces that will push down US exchange rates. But in countries other than the US, the effect is likely to be of a demand shock, unlike the US, where it's a supply shock, because inflation will come down, at any rate, in my view, somewhat, and output will come down quite a lot. That means we're facing, all of us, a demand shock, and that implies that the trend in interest rates is going to be down. I don't know whether you saw it, but Charlie Bean, who was deputy governor of the Bank of England and then head of the OBR, has been suggesting that we cut interest rates in the UK by 0.5% at the next meeting of the Monetary Policy Committee. And I think a pretty sharp decline in interest rates, official interest rates, is quite likely everywhere, including the US, under pressure from Trump, but it will take more pressure from the Trump to do that. So the cut in US interest rates may be somewhat slower to occur. But what we have is a situation of really totally massive uncertainty in which any forecast is likely to be uh, made incorrect by a statement that Trump makes the next day. So what do you do under these circumstances? And this actually is a situation where FPAS 2, with its emphasis on scenarios, is actually about the only thing that you can do, because I'm the central forecast. Doing a central forecast is almost meaningless in the sense that you really don't know what is going to happen at all. You can't put any weight on the central forecast at all. All you can do is really look at scenarios. And the problem that we've actually got now is that there's a multitude of scenarios. And who knows what Trump is going to do? Who knows how the political situation in the US is going to pan out? Who knows what the situation is going to look like next week, let alone next year? Now, what would I do in terms of trying to look at the scenarios? I think one clear scenario, a downside scenario, that any central bank ought to be considering is a world recession, where Trump pushes on sufficiently, and the decline in investment because of the uncertainty and the decline of exports in the US and elsewhere drives the world into a significant recession. I think that that's a possibility. And I think that that is the downside, which you certainly ought to look at and decide how you would sort of respond under these circumstances, which would probably be consistent with Trump pushing on with trying to raise the general level of tariffs to a much significantly higher level than the starting point, even not necessarily as high as they were before he did the pause yesterday. How about the upside scenario? I think this is more difficult, but you might have an upside scenario in which uh, maybe I have my sort of headline would be Congress rebels and claims that, what is quite correct, that there is no emergency enabling the president to set tariffs unilaterally, and that setting tariffs is a function that which was placed by the Constitution on Congress. And then the question would be, what would Congress do? And I think that Congress would go ahead with some greater tariffs because out of loyalty to Trump. But if we got a situation in which Congress reasserted its power over setting tariffs, tariffs were set at a more reasonable level, with, I think, the exception of China, where I think the tariffs would remain high, and possibly the countries through which China might try and send its exports to disguise their origin, Vietnam, Cambodia, and Mexico to begin with. So my scenarios would be downside a world recession, upside Congress retakes control over tariffs and decides on a more modest uh, set, and the world uh, escapes any severe downturn. But the rate of growth undoubtedly will get cut back. And whatever happens now, we have had an enormous shock to confidence, an enormous shock to certainty. And it will, under these conditions, investment and exports worldwide will inevitably be lower. The question is just how much lower.
Yeah, yeah, that makes sense. For the upside scenario, I'm just going to play devil's advocate a little bit and see what you think about this. So Scott Bessent, the Treasury Secretary, has suggested what would be my upside scenario is that we are rebalancing towards importing less. And at the same time, this will shock the Chinese government into really, truly stimulating the demand in China, and thus sort of they will become this source of demand for the world that we've been. That's his upside scenario. What do you think about that?
I think that's right. I agree with that. I should have said that. You can't think of everything. But
I
I
agree.
think the Chinese are absolutely bound. They have to try and stimulate consumption. So consumption in China will go up quite strongly. Um, and that will lead to more imports from countries other than the US into China. And that will be part of the. I think and that will happen, I think, on both scenarios. Even with a world recession, China will have to do that so that the shift of Chinese policy is what I would include in both my downside and my upside scenarios.
Yeah, and does it also include, to a lesser extent, a shift in German policy that we've already seen?
Um, I haven't mentioned Ukraine, and the shift in German policy was partly determined by the concerns about defense
Hmm.
in Ukraine. Um, and that's another scenario. What happens in Ukraine? Um, and how many scenarios do you think a central bank can run?
Yeah.
Um, and you could have a scenario, either an upside or a downside scenario, with the war continuing, or you could have an upside or a downside scenario with the war coming to an end. Because I don't think that you can really talk uh, very clearly about Europe and how Europe is going to develop without mentioning Ukraine, because the a lot of the pressure in Europe is to shift to a condition in which they're better able to defend themselves and to support Ukraine through whatever is coming.
Yeah. I think this is actually the perfect moment to switch to Vazgen, who is actually making these scenarios probably as we speak. Professor Goodhart mentions that, look, it's actually really tricky to make. You can make so many scenarios, yet FPAS Mark II, the idea is that you make two central scenarios and then maybe some sort of wild card scenarios. Vasgen, can you maybe tell us a little bit of how you're doing that? And if possible, I'm not sure if this is possible, but it would be great if you can give examples from the tariff sort of chaos right now.
Yeah, sure. Thanks. Thanks. At first, I would say that Professor Goodhart brought a brilliant example of an FPAS Mark I baseline approach at the beginning of his speech. Then it turned into the FPAS Mark II world, bringing some couple of scenarios around like what the market currently expects. So let me, before coming exactly to the scenarios around these tariff policies, let me go a bit back into the history to show you like how we came to this FPAS Mark II policy. So how we transitioned into that and what was the causes, because the causes were exactly what we see right now in the world. Because, our shift from the FPAS Mark I to FPAS Mark II was in some sense a natural evolution, like driven by the increasing uncertainty around the world and the complexity of the global economic environment. Because some key global events, like for example, COVID-19 and another stuff underscored the limitations of FPAS Mark I. For example, the COVID-19 pandemic introduced unprecedented uncertainty at that times in terms of economic forecasting, making it clear that our existing framework that we had at that time was not well equipped, to handle rapidly shifting conditions in the global economy. And I would say this is also the case that we have now, mostly like in the FPAS Mark I central banks, which are struggling to design a prudent baseline scenario nowadays. So this after the COVID-19, we had another like major events. I would say the Nagorno-Karabakh war in 2020, and even more critically, the 2022 Russia-Ukrainian war, which was also a visible like evidence that this FPAS Mark I framework was very, very limited in this kind of very high uncertainties. So another real world example of these challenges that I want to stress here now was because it is already a history. So we can talk about that exposed and bring some interesting narrative also for nowadays. So it was in February 2022, just before the war began in Ukraine. At that time, I was responsible for global economic projections and our forecasting process under FPAS Mark I. As you know, like it follows a structured, baseline-driven approach. So the challenge was that information was changing at an extraordinary pace, as we also face currently. So almost every day or each day, I would develop a new baseline projection for Russia, incorporating the latest economic data and geopolitical developments and everything. But by the time I presented that, even for our internal staff discussions, not saying about even about to the board, the situation had already shifted. So that there was strong debate even at some point within our team. Some were arguing that war was highly probable, while others, I would say including me, pointed out that no war has officially started yet. And the key challenge was that let me put it this way, whether we can include a war in our baseline scenario, even if that's very highly probable, if the war hasn't started yet. So the difficulty was that traditional forecasting methodologies requires baselines to reflect the most probable scenario. Yet, as like time sometimes passed by, it became clear that relying on a single baseline was becoming impractical. So I would adjust the projections, return to discussions, the next day go back, revise them, again go back to the board, and the same almost every day. And then finally, Russia invaded Ukraine, and our baseline instantly became impractical at that point. Then we came back to the office again, trying to design another baseline, including already the war. But the next day, the West came up with some severe sanctions on Russia, including the exclusion of Russia from the SWIFT and so on, which also like changed the situation dramatically after that. So then we designed another baseline for that. So that was a game of like designing a baseline every day, I would say, for 10 consecutive days prior to the war and some couple of days after that. So this experience highlighted the core weakness of FPAS Mark I. So it struggled to keep pace with rapidly evolving situation globally. In contrast, I would say under FPAS Mark II, so we would not be locked into a single baseline. Rather, like instead, we would develop multiple scenarios, for example, assuming no war under one scenario and assuming let's say like a full-scale conflict under another scenario, and maybe a more severe scenario with some prolonged geopolitical crisis. So even though the situation or the information changes dramatically, like these scenarios wouldn't or wouldn't be changed so fast. So the scenario-based approach would allow us to assess risks more effectively, ensuring that policymakers were better prepared for different possible futures. But FPAS Mark II is not just about the methodology, with what I also want to stress here. It represents a fundamental shift in how policymakers think. Under FPAS Mark I, decision-making was centered around an optimal monetary policy reaction function, I would say. So actually, basically what we do, it was that, so we design a policy rate path to minimize the welfare cost given the most probable scenario or the baseline. But in FPAS Mark II, this approach has been replaced by a least regrets policy. So instead of optimizing for a single forecast, policymakers evaluate multiple scenarios and ask, what is the worst case outcome that we must avoid, or what we fear the most? So let me put it this way, like rather than fine-tuning the monetary policy to fit a single forecast, we ensure that monetary policy decisions steer the economy away from highly unfavorable situations. We call these kind of situations like dark corners. So this shift is critical in times of extreme uncertainty. When the economic landscape is unpredictable, the priority is not just optimizing for a baseline, but ensuring resilience against the most severe risks. So FPAS Mark II provides the tools to do exactly that, making monetary policy, I would say, more flexible, more adaptive, more forward-looking, and more prudent. I would put that in that way. And coming to the current situations, as Professor Goodhart already talked a lot about that, I would add another maybe couple of things on top of that. So I would fully agree on the case B scenario. So that's I would say that's gonna be the global recession, not only in the United States, given the very high extreme uncertainty that we have now. So we already see some signs of precautionary savings going up and so on already in the hard data. So, but about case A, I would say that of course, there are lots of case A's and case B's. So one option is what Professor Goodhart suggested. Maybe another option is what the head of the Treasury, Scott Bessent, said. So let's imagine that, even that's a bit hard to go into that world now, given the challenges we have at the table. But let's imagine that this trade policy is credible, and the firms or the real sector reassesses the situation and tries to readjust to adapt to this new reality, and they start to invest a lot into domestic economy to shift the imports to domestic production. But what we will see then, given the I would say tight labor market conditions now, and also taking into account the strict migration policy that we have now, which is also another major key event that we see now. So that investments or so of course that investments or reindustrialization will require much more working hands going into this new into these new firms, new or extension in the capacities that currently are there. So we will see another like inflationary pressures coming from that side. And of course, the difference in this scenario on the case B is the sticky inflation. If under the case B, as Professor Goodhart also mentioned, we will see some spike in or only in flexible inflation, which might be in some sense a transitory. Under case A scenario, we may have seen some rise in some acceleration also in sticky prices on top of the flexible price inflation. So the situation will be absolutely different there, and the risks are absolutely different there, and the monetary policy reaction will be absolutely different there. So what I mean is that under the case A, I mean, maybe in some sense the Fed has to react aggressively, I would say even raising interest rates or keeping them high for a prolonged period. But under the case B scenario, so they also have to react aggressively enough, but to contain the falling demand and ensuring the inflation is consistently back to the target in the medium-term horizon. Maybe so. That's my reflection on this.
Yeah. Thank you so much, Vasgen. Actually, it got me thinking about what you said and what Professor Goodhart said, in a sense that Professor Goodhart, you said, look, the world is facing a demand shock. The US is facing a supply shock. But given that in the US there's now also so much uncertainty and reciprocal tariffs, that's maybe a loaded term now, but from the rest of the world back to the US, or at least from China and Europe, are they facing maybe a supply shock and a demand shock at the same time, or wouldn't you say that?
I think the world outside the US is facing essentially a demand shock, and it's essentially a supply shock in the US. I agree with a lot of what Vazgen has been saying, but what I think he misses out is the fiscal situation. Two things he misses out. First one is the fiscal situation, which I think is likely to go really quite badly adrift, in the sense that the deficit and the debt will get much worse. And the second one that he is missed out, or maybe I'm wrong, again, we don't know under this uncertainty, but how far can the Fed resist a dominant president? And Vazgen was talking about in his case A, the good case A, that the Fed would have to raise interest rates in order to restrain inflation under the circumstances in which investment starts recovering quite strongly in America. Just think what Trump would say. Just think what Trump would do. And fairly soon, Trump is going to be in a position to replace Jay Powell. And he will put in somebody in that job who will do exactly what he wants. Now, that's just the one person in the FOMC. But then there's a question of whether the other members of the FOMC would be prepared to outvote Trump's choice. Among the other uncertainties, which we've got to take into consideration in deciding your scenarios, is the interplay between the president and the Fed, and which you didn't mention at all.
Yeah, in fact, I think just this morning, Trump either tweeted or put on Trump's on his own platform, Trump Social. He said literally, "We are a strong country in the US. We need low interest rates." So he has made his position very clear. I agree. What do you think about that risk, Vazgen? How would you take it into account in your scenarios?
Yeah, of course. I will fully agree with what Professor Goodhart said. Fiscal policy is absolutely another source of uncertainty here, especially nowadays. But yeah, but also another major issue here is the Fed's credibility. So whether the Fed's credibility has already been damaged in some sense, that's also another source of uncertainty. So what we actually do or how we might address also this risk here. So I would say that's an extreme case or an extreme scenario here. So what if like they are faced with this kind of issues? I would say like a rise in persistent inflation on which they have to react aggressively, but their credibility is lower now, or they are sufficiently constrained on their monetary policy, like going upward. Maybe that's an extreme case, which we might also consider under the FPAS Mark II framework, and of course that implies absolutely different results and so on.
And may I add another? Oh no, wait. Let's see if Doug has an uncertainty to add. I have one as well.
Well, I would only want to say is that we've been building an analytical framework that has endogenous monetary policy credibility, and we just are about to publish in Oxford Economic Policy this framework that allows you to help think through these kinds of issues that Charles and Vazgen are referring to. So I just wanted to note that. There are some interesting, in fact, when you were initially talking, your first remarks, Charles, and you were describing what I would say is a case A kind of scenario. Once you start going down the case A scenario, then you start thinking about the case X, which is what you said in your response to Vazgen about what if, the way I interpreted it, what if term premium on 10-year bonds were to spike up, because of concerns about the entire policy framework, not just the tariffs, which are stagflationary, and they create the conflict between monetary and fiscal. But of course, fiscal itself being unsustainable and resulting in long-term inflation expectations rationing up. Now, up to this point in the bond market, long-term inflation expectations have been remarkably anchored right through COVID and so on. Medium-term inflation expectations have shifted up. And the question is that if you throw on these stagflationary shocks and expansionary fiscal and possibly a monetary, because they have to monetize to keep uh, interest rates down. In other words, if the term premium rises, the only way that the Fed will be able to keep market interest rates down is through monetization and so on. And that, of course, would then at some point just trigger a crisis and so on. But is that kind of how you were thinking about it, Charles? Because you were
Yes.
sounded to me like
Yes.
you were talking about, yeah.
Yes, exactly.
Okay. Okay. Um, okay. So this is what's happened. We're going to talk a little bit about this in the next session, where I've had my students go through what is, all the tariffs, trying to study their impact using input-output analysis, okay, where you ask, what goods are finished goods and which goods are or intermediate inputs, and what would the effect be if they were passed on? Okay, and those numbers, you'll to go to Vazgen's story about changing the forecast every day. We were trying to lock in, Charles, last night our market reference scenario just before Trump unleashed the revision. And so what that meant in my household was the superlative. I won't mention exactly what it is, but because we were just trying to lock in this damn baseline scenario that was consistent with what's in financial markets. And the problem is that equity prices rose by 10% in minutes. So I think Vazgen, it's not just people in Armenia and so on that face that kind of problem of uncertainty and so on. So anyway, but the bottom line is this: it's still a good idea, I think, for people to go through the process of making assumptions. I think it's really healthy for them to think about and do that, even if they change a lot. Just think of it as more practice and so on. But of course, they have to reflect upon what are the implications? How do we use this information and so on? So we put together every week now our case A and our case Bs and our market reference scenarios. We release them on Fridays and so on, and then once a month we release this global economy risk assessment report. And Charles, I hope you see on April 21st that it's going to reflect a lot of the comments that you made earlier about what implications this has for the global economy and potentially for thinking about. I wanted to ask Charles this because I think the U.S. is quite a bit different than the UK. Like when you're talking about an open economy and how you think about monetary policy now. But I wanted to ask, maybe you could talk a little bit about that. Sorry, Joeri, but
No,
I
go ahead.
was, I was really curious about what the differences are there.
Well, and the UK is a very open economy and the ratio of imports to total output is much higher. It's more than twice in the UK what it is in the US. And so the US is in a position to threaten other countries by imposing tariffs to make them change their policies because it hurts other countries more than it hurts the US. And I think that is one of the features of the present situation. And there's no doubt that Trump has a considerable amount of power, and there's no doubt that Trump will get in negotiations with countries, particularly in Europe and elsewhere, a lot of what he wants. And so that is worth working through. And the negotiations are going to occur. One of the things that I really don't know, and I don't know going into this discussion, and I'm sorry, but I should, is that Trump said that he was not going to defer his tariffs for 90 days on countries which have retaliated.
Mm-hmm.
Now, one of the areas that has retaliated, yes, before he made this move, was Europe. And what I don't now know is whether that means that the much higher tariffs that Trump has introduced on the EU and the countries in the EU will continue, or whether they have been deferred for 90 days in discussions. So I don't know what is happening in the relationship between the US and Europe, which is an important part of the immediate conjuncture, among many things that I don't know.
Yeah. The last
but
list I saw, it was only China that kept the tariffs. It could be that
But he
Europe.
said any country that retaliated.
Yeah, no, I agree. So it's weird, right? But it could be that Europe just this morning let the retaliation actually go into effect or not, which maybe sort of may have intervened with the timing from Trump's side.
It needs
Yeah,
clarification, which I
yeah,
cannot give.
yeah,
But and I think that there is a general point, which is that the degree of independence of any central bank uh, is limited by the willingness of the executive and the legislature to allow that to continue. I take, for example, a country like Turkey, where Erdogan had some weird ideas and imposed them on the Central Bank of Turkey for a long time until they became obviously disastrous. Nixon pushed Arthur Burns around, and Trump is going to do exactly the same thing to the Fed. And I'm sorry, I'm reiterating the point that you've got to take in your scenarios, you've got to take some position on the likely degree to which Trump can bully the Fed to do what he wants, either by appointment or other appointments or otherwise.
yeah. The latest news is that Europe has been exempt 2 hours ago on European news. So that's just a little
Yeah.
update there. Um, Vazgen or Doug, do you want to comment on maybe sort of how influential Trump can be on bullying the Fed, or is it just another
I
uncertainty?
I think that it just has to be the case that there's enough pain. My interpretation of what happened yesterday was it was a reaction to panic in financial markets. Okay, so that will obviously, I think, be an important factor on their mind. But more importantly, now that you have the Chinese tariffs on the U.S., those are going to hit um, uh, the base of the Republican Party, and as a result of that pain, he will start to lose support. Uh, it's just so extreme. So I don't think it's going to require something as extreme as trying to put a law that limits his powers on tariffs. I doubt that would happen, but I think that would happen effectively by basically him having to back down on on what he's doing because of the economic consequences and the turmoil that it's going to create and so on. So I'm a bit um, I'm a bit more optimistic, perhaps inappropriately so, Charles. Maybe too optimistic that there will be some reaction from the
Perhaps to get a
markets.
scenario, what we need is a psychiatrist to give us a good reading of Trump's psychology.
Yeah.
Yeah, okay.
Uh,
Yeah, maybe.
Vasgen, I have a question for you actually. I think one thing we haven't really talked about yet is, for example, you mentioned the Russia-Ukraine war really influencing your scenarios. But there I thought it was really interesting that what was a negative event for almost everyone and hit European economies really hard was actually a positive or a case B, I think, right? For Armenia. So how are you looking at that now in Armenia? Or are you currently considering Armenia just part of the rest of the world, so to say?
That was absolutely the point because, in the brink of the Russian-Ukrainian war, so I talked about the baseline for the Russian economy, not even for the Armenian economy, because the Armenian economy were also going to be hurt by what was going to happen in Russia. So there were much uncertainty in that side. And so, of course, there were lots of scenarios for Armenian economy. But at the end, as we had to come up with some baseline, like after the Russian-Ukrainian war, so that which actually began and so on. So we came up with some baseline scenario for Armenia in that event. So we cut our growth rate for the year of 2022 from 5.6, if I'm not wrong, to 1.6. So under the baseline scenario, we assumed that, the Russia is going to be really severely hit by these sanctions, and so the Armenia would be also hit. But the situation was absolutely different from what we imagined at that time. In 2022, we end up with the GDP growth somewhere like close to 12%. As Russia was severely hit by the sanctions, and they were cut from the financial markets, and their imports were also banned from the West. So Russia, in some sense, had no way other than importing other goods from where that was possible at that time. And also, there were some like a couple of millions of Russians that flew away from Russia, and they were like very high quality workers in IT and so on. And we got some portion of them, like close to 50,000. So that was like I would say, huge positive demand shock instead of a huge negative shock. Yeah. So that's the case also for now. So we are now, as we have a different thinking and framework, in some sense, we have, of course, I would say that we were also considering these kind of scenarios in 2022. But as the framework was different, even though we were having some discussions in the board, some were arguing that, we will benefit from that situations, and other the vice versa and so on. But we had to come up and publish some baseline where the assumptions has to be, I would say, what the most probables may seem at that time. But what we have now, so we are talking in terms of different scenarios. So I would say that over the last quarter in our inflation report, our case A scenario for the Armenian economy was what may gonna happen in the Russian-Ukrainian war. So there were some events. So the scenarios are very different also for now. What if the war ends in Ukraine? But that also have very different implications for Armenia economy, depending on how it may end, and whether the sanctions, for example, may be canceled that were put on Russia, or they will be canceled partially or over time, or they will not be canceled. So if they're not gonna be canceled, but the war is over, that's another positive demand shock for Armenian economy. So because there might be some huge infrastructural projects going on in Russia, but if they still are out of the global market, so Armenia may still benefit from that situation further. But also depending on the parameters of this peace talks and so on, I mean the possible peace, that may also have very much different implications for Armenian economy.
Thank you. Maybe as a final question, Charles, do you see a difference between countries already starting to emerge? You've previously said, look, supply shock US, huge demand shock rest of the world. Could you see already maybe some Armenia's sort of popping up in the rest of the world?
I'm the range of my sort of abilities is strictly limited, and I don't think that I feel really competent. But the reports that I've received are that emerging markets are going to be worse hit than the advanced economies, and that advanced economies, as in sort of Western Europe, are better able to adjust to a severe shock to exports. Um, and as Vazgen was saying, Armenia's position close to Russia depends very much on what happens in the Ukraine war. And I think that if I was in Armenia at the moment, I would take note that Trump is clearly trying to reduce the extent of conflict between himself or between the US and Russia, while ratcheting up the conflict between the US and China. So that I would think it very likely that if there was to be an end of the war with Russia, that the Russian sanctions on Russia would disappear really very quickly indeed. That would be a strong, I would, considering what Trump has done and said so far, I would think that that would be highly likely. So I'd have thought that the end of war in Ukraine would be accompanied by an end of American sanctions. Depending on what happens, what will happen in Europe and European sanctions is another story.
Maybe if I can add some couple of remarks here, because I missed that in my previous answer, because, for the rest of the world or for emerging markets, I would say for Armenia, which I think our example may be also applicable for lots of emerging markets. So Armenia is a very small and a very open economy. So we import like so the imports constitute some 40-50% of our GDP. So we are very open. But so let me distinguish by like between the direct impact and indirect impact from these tariffs, like trade policy from the US. So the direct impact, I would say, will be very, very small for Armenia, even negligible, because our exports to the United States are amount like to 1 to 2% of our total exports. So that's not really the case for us. But what we fear more is the global uncertainty. And the global, as also Professor Goodhart fairly mentioned, this huge rise in global uncertainty may have very, very bad consequences also for us. So we may have some huge negative demand shock from the global economy. But what is also different this time from these kind of situations, from these kind of shocks that we faced also in the past, is that usually under this kind of circumstances, emerging economies face also some capital outflows. Like from emerging markets to the advanced markets, and first of all to the United States. What we observe up to this point is that this is not the case for now, for this time, because the problems, the core of the problems are in the US or maybe in the advanced markets rather than emerging markets. And maybe the emerging markets are in some sense like relatively not too much risky this time as we were, for example, under these kind of situations before. And we don't see some pressures on the currency, national currency. So usually under these kind of situations, we used to see some depreciation pressures, but this is not the case for now. And so what also makes a difference this time?
That's very interesting. I would wonder if how these pressures are now for emerging market economies that have really built their economic model around exporting to the US, which is much more Southeast Asia, I think, right? I don't think anyone here exactly knows how that is right now, so maybe that's a good open question to end our discussion on, so that we know we have something to talk about another time. Thank you both so much, or the three of you so much for attending. I thought this was, yeah, really interesting to do like a small scenario analysis actually already about a very rapidly developing situation. So thank you so much.
Thank you.